to everybody that's on here live today, welcome. Looks like we got about 20 folks on now, so it's a good time to get started. Just by way of introduction, my name is Mckern. I'm a retired Army colonel and organizational consultant and executive coach in the Phoenix Valley. I've got the privilege of leading a peer group of Vistage CEOs in a peer group setting here in the Valley. Really honored to be able to do that and work with so many of the leaders in our local community. Really excited today to welcome a very special guest to Making the Mark. We have the privilege of having Harry Barth with us. Harry is the founder and senior partner of Barth Calderon. Barth Calderon, they specialize in asset protection, estate planning, and business support. You know, Harry's going to bring some real insightful perspectives to what's happening in the arena of tax proposals in the future, as you've all heard, with what's going on out of the federal government and the state level. So, Harry, without further ado, I'm going to make sure we get you spotlighted here, and I'll let you follow on with a bit more of an introduction, and I would love to hear what you have to say today.
Good. Thank you so much. It's just great. Great to be here. So a couple things. First, I saw Alexandra pop up. Hello, Alexandra. So Tom DeVries pop up is hello, Tom. And so we start today. We're going to do a little journey for about an hour. And for this hour, I want you to understand, if you remember the Greeks, and the Greeks turned around and said that if they didn't like the message, they killed the messenger. Don't kill the messenger, because you're not going to like the message that we hear today. Let's understand that the power to tax is the power to destroy. And you know, it's an interesting statement when we take a look at how these proposals are being brought forth by our government and some of the reasons that they are. President Biden, God bless his soul, has a paradigm or a belief. His belief is, right or wrong, we're not going to be political, and that is work should be rewarded and not necessarily inheritance and or wealth. So wealth and inherited wealth should bear the burden of programs which will enhance wage earning work. Now, that's a very interesting statement. And I'll take you back a little bit about some aspects of United States tax policy that I think are very, very important to today's meeting. For, my God, the last 100 years, and I've been doing this for 50 of the last 100 years, hard to believe, but the last 100 years, American tax policy has always been divorced to a great degree from American political policy. So one of the reasons people from all over the world brought investments and assets to the #1 place in the world was the United States of America, because they could count on certain things. They can count on the stability of our tax system, the asset protection that was available for, matter of fact, one of the best asset protection countries in the world was the United States for people outside of the United States, to encourage dollars and other currencies to come to America. And even though we've had all kinds of political rhetoric, tax policy, we had a little increase in capital gains, we had a little increase or decrease in estate tax exemptions, but that's changed. And you'll hear that when we talk today, that this tax proposals, and there are many faceted ones that we're going to speak about today in our journey together, are politically in many ways motivated. And their goal is not so much the raising of revenue, even though it's couched in terms of raising revenue. It's more about destroying wealth being concentrated in the hands of a small number of families, our political speak of income and wealth inequality in America. And the way to make that turn to the left, again, left from an economic point of view, is if we can break down wealth from one generation to the next, we begin to cure the inequality in America. Now, let's also understand some things about the vast majority of the tax proposals that we're going to talk about today. As far as estate taxes are concerned, which is going to be a primary highlight, they won't affect you. It affects transition of wealth from generation one to generation two. Most of the tax proposals today that have been enacted over the last 10 years have been temporary. They have not been permanent proposals. And we expect that if these proposals are adopted anywhere near close to the way that they were introduced, they'll be temporary as well. How long temporary is, we don't know. So you might say, well, we can outlive this tax craziness with one few exceptions on the capital gains, which we'll talk about. But it'll change. We'll get some tax sanity when it comes back to us again. Maybe yes, maybe no. So the big thing we're going to be taking away is a lot of uncertainty. We're going to talk about planning for the worst and hoping for the best. The other thing that's important is that many of these proposals, the way that they were introduced, may not be enacted into law. However, you got to think about this for a second, that President Biden in his campaign, political speak, so to speak, most of the proposals that are being introduced into the Senate and the House are almost lifted from the Biden campaign. So we're pretty sure, 99.999% sure, that they'll be signed by President Biden. Not moderating to the right or to the center, but a push towards the left. If he doesn't sign, Kamala's going to sign. And we're pretty sure now that the Senate is blue, at least for now, that the Senate, through budget reconciliation, needing 50 senators, will sign off. And very important is they had to check with what is known as a parliamentarian in the Senate. Well, a parliamentarian tells them that, yes, they can bring this tax legislation through to impact us through budget reconciliation. And what that means for lay people is basically they don't need 60 senators to have it filibuster proof, but only 50, and then Kamala can sign. So we have all of that, and we have the words of Donald Trump echoing in many ways, elections have consequences. So on the journey today, maybe at the risk of an oversimplification, I want to talk to you a little bit about what we can anticipate and a little bit about what we can do about what we anticipate. So let's start a little bit and talk about the proposals for estate taxation. Now, I want to change the words around so it brings it more relevant to every one of us. This is the transfer tax. This is how much money we have to pay to the king in order to transfer assets from us to the next generation. So we got to pay a toll, okay? Now, here's the way the current toll is enacted. Every individual in the United States of America has $11.7 million under current law that they will make, we'll round it to 11.5 million, that we can give to the next generation without having to pay the king any transfer taxes. A married couple would have close to $27 million of, $23 million worth of assets that they can transfer from one generation to the next without paying any of the transfer toll. Now, understand that 95% of America would not even come close to those net worth numbers. So hence, actually about 4.5% of America does. And so they named this act the 4.5% Act because it was literally targeted to those of us that may have some wealth. Now, if we have more than 11.5 or 23 million as a couple, and we are transferring to the next generation under current law, we pay the king 40% for the privilege of that transfer. So if we have $10 million worth of assets that are over the exemption amount that we currently have, 40% of that, or $4 million, we have to write a check to the government for the privilege of making that transfer. Now, think about it. This is assets that we've built over all of our lives. These are assets that we've paid income taxes on all of our lives, and now we have to pay 40% to the government in order to transfer it. Now, think about that for a second too. There's always compliance costs. So we have to hire people to help us work around these things. We have to get things valued, which can cost hundreds of thousands of dollars of appraisals that are involved. And another, kind of we'll call it sinister aspect of that is that, if we have a portfolio of $30 million worth of real estate, that's not liquid. Where am I going to get that? They don't take pieces of real estate. I got to get cash, and I need cash in 9 months. I'm not selling the property. There's just an arbitrary line that drops. I got to get cash in 9 months and do it. And the moment we come under pressure, two things happen. If we don't have the full and fair opportunity to market our property over a period of time of marketability, we will pay, the estate sale. That just means we can, these people who are under pressure, we can give them less money and buy their assets. So there's an additional tax besides the cost of compliance. And that does not take into consideration market conditions. Right now, where everybody is, market conditions may be popping in the area of, for example, real property or business values. But what if we die and it's a period of 40% or 30% or 40% declines in values? We can't hold until the next valuation comes along because we have to pay the king as a result of the transfer, which is caused by death. Now, also, let's understand under current law and under new proposed law, there is no transfer tax between spouses. So we could set that one aside a little bit. So that's our deal right now. 23 million, 40% of everything above 23 million, single, 11.5 million, 40% of everything above 11.5 million. It's nauseatingly enough. Now, because when Trump and his team adopted these higher estate tax exemption amounts, they also couldn't get 60 senators. So that was brought in under what we call budget reconciliation. Same crap we're talking about today. So it means it could not last forever. It was for a limited period of time. And most tax legislation has been for a limited period of time. So even without Biden and the Senate and the rest and the turn blue and the turn to the left and all the rest, on December 31st, 2025, the estate tax exemptions of 23 million for a couple revert back to the $10 million exemptions that they were in 2017, or $5 million per person, but they may be adjusted for inflation, so maybe it gets up to $6 million per person. And a rate of 40% of everything above that. So political change, no political change, unless we have a red White House, a red House, and 60 red senators. On December 31st, 2025, we're going to drop from 23 million to 10 million. That leaves 13 million exposed, round numbers, $6 million of transfer taxes that come to play. Let's add insult to injury. So that's not enough. So here are the proposals that were introduced into the Senate about a month and a half ago, 2 months ago now. And let me share with you what they are, because they are a little bit challenging. And there are some significant aspects of this that I will explain as we go along the way. So under the Biden proposals, that exemption amount now of 23 million for a couple, 11.5 million for an individual, drops effective. Now we're going to talk about effectiveness in a few minutes. Effective, they told us, January 1st, 2022, from 11.5 million to 3.5 million. So the maximum exemption would be $7 million. $7 million we would be able to transfer to Generation 2 without the imposition of federal transfer taxes. However, the rate of taxation is now going to move from 40% to 45% at a minimum. And then it's graduated up based upon the size of the estate, goes to 55%, 50%, 55%, and then a 65% bracket. My God, a 65%, you got to have $1 billion, but 65% potential confiscation by the government in transition from Generation 1 to Generation 2. That is startling and amazing. So that is the proposal that we have. Now, the other thing that's insidious about it as we journey through this together is that under the old rules, all the old rules, even go back to Bush and others, whenever we had these exemptions, we understand that we could be subject to periods of inflation. So every year, what started as, for example, a $10 million exemption now is an $11.5 million exemption because of cost of living adjustments that go along the way. In the specific proposals brought to the United States Senate, there are no increases for inflation, which actually makes the $7 million or $3.5 million exemption even more insidious, because as the cost, the rising the value, the dollar goes up, inflationary value of the dollar goes up, inherently the estate tax becomes even larger. So now the impact of going from 23 million down to 7 million and a 50% rate with $16 million differential, our cost to transfer things from Generation 1 to Generation 2 is now at a minimum of $8 million that we didn't have before. That, ladies and gentlemen, is significant. But the list goes on. And so we talk about the exemptions, and we're going to talk a little bit about step up in basis, but there's another one. So the other one that we have, and the president says he would like to see the estate taxes return to what they call the historic norms. The historic norms, 3.5 to 5 million, rates 45, 50%. And I don't know what historic norms or fair share means, but I know that this is extremely difficult. But there's another principle. So the estate taxes or the transfer taxes at death, we got that exemption. Now, under the current rules that we have the estate tax and the gift taxes. Gift taxes, so we give stuff to people, we have to pay a tax too. But they have been unified, meaning that I can give to my children $11.5 million today and will not be subject to 40% gift tax, because the rate of gift tax is the same as the rate of the estate tax. So that gives me an opportunity to make a gift today to my children under the exemption amounts that we have, and then have all the future growth of that estate actually wind up in the estate of my children rather than in my estate. So gifting becomes a very important component. And a lot of people didn't realize that we have this beautiful gift tax exemption that's equal to the estate tax exemption. So on death or on gift, it's the same. Well, boys and girls in Washington are up to some changes there as well. So what they want to do, and in the proposed legislation, is to change the gift tax exemption and detach it from the death tax exemption, and saying, hey, Paul, hey, Mark, during your lifetime, you can give up to $1 million to others, and anything you give to anyone greater than $1 million today, we want 45% tax in order for your ability to make that transfer. That eliminates 2/3 of even a smaller exemption. So today a husband and wife can give away 23 million. Now it would be down to $2 million. The significance of that is close to $10.5 million of estate tax and gift tax exemptions that are to be evaporated. Okay. So let's talk about this a little bit. And I have a listing of things that that are interesting. So so that's important. I want to understand that's the estate and gift tax proposals. So allegedly, just for all of our own information, we have a bit of a runway. We have a bit of a runway that's going to run from now until the end of the year, but not practically, where we can do some due diligence, evaluate everyone's situation carefully, and see what, if anything, we should do to take advantage of the much more favorable laws that we have now for a family than the laws that can be impacted on January 1st, 2022. So I think that's important, but there are some issues that are associated with that as well. So although they claim that the January 1st, 2022 would be the date of implementation, even on the exemption amounts, practical reality says is that even if we started now on complex situations, did all the due diligence that we needed to do, craft all the structures that we needed to craft, affect all the transfers, get them appraised, get them evaluated, get them done, answer any and all questions, it's still going to be a challenge before the end of the year. So we have about 7 months left, and soon all of the necessary ancillary professionals with this avalanche going on will be unavailable, and just by storm, we'll walk into January 1st, 2022. But what they did in this legislation as well is not, because here was the goal. Remember, the goal was not to have wealth concentrate in the hands of a few families in America. That was the goal. And it's been the goal of the estate tax. It's never a revenue raiser, almost for the last 50 to 100 years. But what's happened is it hasn't worked. And the reason that it hasn't worked, and wealth is still concentrating in the hands of wealthy families, is because people have been able to hire competent professionals. We have a whole toolbox full of tools that, with appropriate, proper due diligence, preemptory planning, we are able to circumvent or find ways to pay the transfer taxes which were then in effect, even when the exemption rates were lower, many tools. So it didn't work. So this time, what they're doing is not only lowering the thresholds, but attacking all the tools that we have to make those tools no longer available to you. So we cannot use the tools to help lower the tax situation that you have, because the goal is not raising revenue. The goal is to destroy from generation 1 to generation 2. You got to believe me on that. This is really what they're after. It's that, we want you to sell all that real estate, give 50% of everything to the government, make 50% available to everybody else, and away we go. It's policy. It's political policy, and that political policy is implemented through the use of the tax code. It's not going to be used to pay for, migrant children and infrastructure. There's not enough revenue raised there in order to do that. So, for example, let's talk about some tools. So one of the tools that we have for individuals that have larger estates is something which is called discounts. So if Harry establishes a limited partnership or a limited liability company, one of those entities, and I have voting and non-voting issues, and I want to give away 50% or 60% of the non-voting issues of my LLC to a trust for the benefit of my children, we've had, and this is more meaningful to those people of more significant wealth, have always had the ability to take what is we call discounts. So when I give my kids in trust 50% interest in my LLC, what might have been $1 million worth of real property, they're not getting the real property. They're getting an interest in the LLC, which is, one, not marketable. It's not marketable. It's not liquid. They can't do it, and they have no managerial control. So that $1 million gift to my children is discounted, sometimes 40%. So it's really a $600,000 gift of $1 million worth of fair market value. A little bit of voodoo math that for years we have used on intra-family transactions to get more dollars out through the umbrella of exemptions that we have. Well. In this legislation, intra-family discounts will be gone. No more. So if I got $1 million of evaluated assets, it's $1 million. We don't care if it's $1 million in an LLC, $1 million in a limited partnership, $1 million straight out. It's $1 million, and we're going to tax the full $1 million, even though it's not liquid and you don't have managerial control on the rest. Ugh, that is absolutely terrible. But they went a little further. They went further in a lot of ways. One of the ways they went further is gifts. We all know about gifts. You know, and you say, oh, people say, oh yeah, I give $15,000. You know, it's actually 15,500 or so to any number of people. So if I have 6 grandchildren, which I do, and I have $15,000, round numbers, which I have, I can give $15,000 to each grandchild. All right, do the math. My wife can give $15,000 to each grandchild. And round numbers, you know, let's use the 10 grandchildren. 10 grandchildren is $300,000 that I'm able to give away without touching my $11.5 million gift tax exemption. And a lot of people do that every year to children and grandchildren. We make gifts. One, it's a great way to reduce our estate. It doesn't reduce our $11.5 million. Well, no more. Under the new legislation, which is being adopted, or they hope to have adopted, we hope not to have adopted, the gift limitation, the annual gift limitation goes to $30,000 per person. Not $30,000 that I can give to a person. Harry can give away $30,000. If I got 10 grandchildren, if I divide it up, it's $3,000 a piece. My wife can give away $30,000. Now I can give $15,000 a year to any number of individuals. That's now cut back at the same time to $30,000 a piece. $30,000 a person. Very, very difficult. And another challenge. I think you begin to see where they're going. And one of the things before we get to some more tools and more factors that are involved, let's also understand that for the implementation of the elimination or curtailment of the tools that I would use to help you, that might not be January 1st, 2022. That's when the exemptions and the rates may change, but the tools may be attacked or taken out of my toolbox upon the enactment of the legislation. Which could be in July or August. All right. And then there's a couple of just unbelievable morons in our government that have even made the suggestion that all of the tax changes that they're talking about should be retroactive to January 1st, 21. So, which by the way, I don't think has a chance of being retroactively implemented, with perhaps one exception that I'm going to talk about in a moment. Because if we do some planning under today's law, that's the law should be governed by, and not upset the apple cart as we go down the other way. So what is the other one? Okay, so you've all heard a lot. So one is another component that they're talking about, and this one has some legs to it. So do the others. You know, it's really scary because we had that perfect storm of blue, and we have philosophically this movement. We'll call it quote unquote to be kind. This progressive movement. But the other thing is, let's talk a little bit about step up in basis. But before we even talk about that, what's up with the capital gains tax? So currently, and we'll talk about it federally, we get to add the state on top of it, depending on what state you live in. California, 13%, Arizona, 5%, Nevada, none. But there's potential state capital gains that have to be paid as well. So today on capital gains that are held over your long-term capital gains, the rate that we pay is 20%. So if I had $1 million capital gain, I'd have to pay to the federal government $200,000. That's enough. That's plenty, but it was a lot less than the ordinary income rate. In the proposal to be being considered in Congress right now and signed by the president is to tax all gains over $1 million at the highest ordinary income tax rate. So that means, let's say I sold a building for $3 million. And let's say that I had I had a basis of $1 million and a $2 million gain. So and the way that they're calculating it is not that we get $1 million exemption. They're basically saying if the gain is over $1 million, in our case it is $2 million, back to the beginning for that full $2 million gain, federal government will tax that at 39.6% because they're attempting to move the individual tax rate from 37% to 39.6. So think about that for a second. 39.6 tax, capital gains taxes, gains tax on sale of an asset, a business, building, real estate, tack on some state taxation, which could be 5 to 13%. If it's a passive investment, tack on another 4%. You could be looking at 53 to 55% taxation on a capital transfer. My God almighty, who's going to, so we were counseling people just in my office the other day, and we were talking about that, and we said, well, if it's not being sold this year, what the heck? You know, what the recommendation is from the professionals to our clients is maybe you don't want to sell, because no one's going to sell into that environment and wait, hopefully, for more sane tax policy. So it's not a revenue raiser for the government because people won't sell. You lower the capital gains tax rate to 15%, and we have more turnover of capital and more revenue to the government, but it doesn't serve the political purpose along the way. So now, if we get to that, the M&A attorneys won't have much to do. The private equity people won't have much to do. The financiers won't have much to do. And the families are holding on to the properties and the businesses that we have, kind of curtailing and freezing commerce because the tax policy just makes no sense. So we have that one. All right, that one has some legs. Now, understand that right now, probably the most powerful man in Washington, or woman, is Joel Manchin out of West Virginia, because he's a deciding vote. And he says, well, Biden and team want 39.6. It's currently at 20. Joel Manchin says 28. So everybody hangs their hat that the Joel Manchin rate will be the one that's adopted. Still has an 8% increase in capital gains taxes. But it goes further. So there is another component that is very much in the crosshairs of the government at this time. This is in this comprehensive piece of legislation, and that is what they call the elimination of step-up and basis. One of the most powerful taxpayer tools that we currently have. So basically, what happens here is if Harry bought a business for $1 million, and now that business is worth $15 million. It's $14 million greater in value. Because why? Because I worked it for the last 50 years, because I signed all kinds of personal guarantees. I lost all kinds of sleep, took all kinds of risk, ran my health down doing everything I do. And with everything, I built a successful business. It's successful. I grew it. I paid income tax, state and federally, all along the path. So the way that it's been for, oh my God, the last 75 years is when I die, all right, we're in a community property state, which Arizona, California, and some of the others are. When myself or my wife die, that basis of $1 million, which would be if I would have sold the company for 15 million with a basis of $1 million, of a $14 million gain, 39.6% of that. Oh God, that's awful. So now under the new proposals that are coming in, here's what they want to do. Now listen to this carefully. First thing what they want to do is say that that $1 million, which before under current law today, if you died today, that $1 million would step up in basis to the fair market value of the property at the time of my death. So if I bought I set the company up at $1 million, it's worth 14 million bucks. I die, my son and my daughter inherit the company. They now have a basis, a tax basis in it because of my death of $14 million. And if they sold the company the next day, there would be no capital gains. They sold it for 14 million the next day, no capital gains tax too. A lot of people don't understand that. All right. This is a very, very powerful attribute of the United States tax system. And under the new proposed laws, there will no longer be a step up in basis. So now the next question is that when will that capital gains tax be due? And the legislation has a fork in it, all right? I think the legislation should have a fork to its heart, but a fork in it that kind of looks like this. So under one proposed aspect of the legislation, my children would now inherit the business worth $14 million. And on the disposition of that business after my death, there would be a capital gains tax between $1 million and the $14 million at 39.6%. So I got a 40% capital gains tax to pay upon the disposition of that business that I inherited from my parents, so to speak. Horrible enough, but at least we're controlling when it happens because it's upon the equity event in the business or with the real property. The other branch says that the capital gains tax is due on transfer. So when it goes from Harry to my children, even though the business is not sold, and even though there is no equity event, we should pay the capital gains tax, or the children should pay the capital gains tax at the time of the transfer. Now, how are we going to get 40% of $10 million or $12 million, $4 million bucks to pay the capital gains tax when we haven't had an equity event? That is really insidious, which will literally force us to sell any business or real estate that we have. Hence, remember, bringing us back to the power to tax is the power to destroy. And then in their wisdom, they're going to give us a credit for that tax against the estate tax. So the estate tax doesn't go away. We would have both a capital gains tax and a estate tax. Now, although they said that this is gunning for the 4.5% of people, you know, the wealthy, they call the ultra wealthy, which is an interesting definition in Washington. We have a couple $100,000 in the bank and a good job, and you're the ultra wealthy. So what happens there is that they felt, oh, this is not going to affect the middle class. Well, I beg to differ with them. Many businesses, although they may give us $1 million of gain that we can get, but hey, what about the mom and pop business that started, you know, with $500,000, $600,000, now worth $4 million, $4 million bucks. That's it. Okay. And we sell that business, and whether, you know, or transfer that business on death, that small business that supported that family for years, even if they gave us $1 million of exemption amount, be subject to 40% tax on the gain of about a 1.2 to 1.5 million. Where is that middle class family going to get that money from? And then the other one too is that when you look at that house, simple house. So right now, what happens with a house? We bought it for 20 years ago, 25 years ago, we bought a house for $500,000. And today that house is worth $3 million. And it is the jewel of the family. It is the home for the family. And now the parents leave that house to the children. And if there is a transfer tax or capital gains tax on that disposition, one, it could be subject to estate tax, but all of a sudden the gain on that house above $1 million, if they use the $1 million exemption, is going to be subject to taxation. Where am I going to find the money? Now, to be transparent, the government has tried to do this before, and it's failed. It failed because at the end of the day, this is horrible. It affects the middle class. It affects everybody. It puts a chilling effect on commerce. There's a reason we have a capital gains rate that's different from the ordinary income rate. And the other thing too, the compliance with it is extremely difficult. How do we comply with that? How do we actually determine the basis? Do you imagine having to go back 20, 30 years to determine the basis of a stock portfolio, a mutual fund portfolio, a business? It becomes the compliance cost in order to comply with the taxation is so high and so complicated that it may be difficult. Now, realizing that all of this is so draconian, Mr. Biden, and again, not being political, I'm just using Mr. Biden to represent the ruling governing power, so to speak, at the moment, said, a lot of people who have a lot of money, you cheat. Of course, we cheat. They think they cheat because why? Because you're confiscating, you're reaching in. I spoke to a client the other day, they're reaching into my house, into my bedroom, and confiscating my assets if these things could, God forbid, ever pass. So because you cheat, and we don't have the resources to do that, I also want to give $80 billion to the Internal Revenue Service to hire enforcement agents. We want to create the financial Gestapo. And so we know that if we have the financial Gestapo being intrusive into every single transaction that we make, we will be able to get for the government $700 billion more from those of you people that have a couple of bucks. So just read it. I mean, I'm not making it up. It's $80 billion should have a $700 billion return on enforcement because, maybe your valuation is off a little bit. Maybe you had unrecorded Bitcoin, we go along. So it's a very, very interesting component. Some of the other things that we also need to understand that a lot of people don't understand, life insurance. So, one of the things that's important is that, ultimately, whatever the tax structure is, we're going to have to work around it. All right. Now, I want to explain to each and every one of you that in the next few months, organizations similar to mine, all right, with appropriate amounts of due diligence, have the tools available to save a family. If a family has a net worth of $23 million or more, we've calculated with the discounts that are available, the tools that we currently have available, we could save it. And the growth on those tools in the next generation rather than yours, which we have now, we could probably save a family up to $19 million of transfer taxes. That is not chump change. That is something that we should look at and look at carefully. So as we begin to understand, we talk about life insurance. So people are going to buy life insurance because it's kind of an inexpensive way, relatively speaking, to pay the government in order to pay the taxes. So we want to pay the government to pay the taxes. Using life insurance, so I got $3 million worth of taxes. I buy a $3 million seconded life insurance policy for my wife and myself. We die, the $3 million goes to the kids give it to the government. The assets, my real estate and business passes to them. Fine, if they don't implement that capital gains thing at that time, which would be just horrible, but has a good chance of passing. So the life insurance was able to pay the taxes maybe 5, 10 cents on a dollar. Not bad. But people don't realize that life insurance that we own is also included in our estate for federal estate tax purposes. So if we bought $10 million worth of life insurance and we bought the life insurance in the wrong way to pay taxes, the life insurance would be subject to tax and we'd have to pay $4.5 million of the $10 million worth of life insurance to the government. So it's very important that life insurance be structured in appropriately and properly designed life insurance trusts. Why do I bring that up? Because remember, in my opinion, this is one man's personal opinion, all right, based upon many years of experience in looking at this and discussing these. The goal here is under the cloak of raising money for the benefit of infrastructure and other things, but is really designed to break down wealth. All right, we should have a home, but not too big, a car, but not too fast, money in the bank, but not too much. A great equalization in the population, whether it's right or wrong, to me, that's the goal. So there is the possibility and the talk that even life insurance, which is put into an appropriately designed life insurance trust, might still be subject to some form of taxation. Now, the insurance lobby is very strong, so I hope that that part of the legislation does not get adopted. So now I could bore you with the fact that they're attacking grant to retained annuity trust, intentionally defective grant to a trust, and a whole acronym of tools that we use to help you maintain and keep that which you've worked so hard for in the family. I know what we can do now. I'm pretty uncertain about what we're going to be able to do in the future. So I think that it's really important that for everybody, at least it's time to take a look-see. And, this conversation is not fire and brimstone. It's more of a fireside chat that inherently says, we can, hopefully it doesn't get adopted, choice one. Two, won't last if it does, because it doesn't make any sense. And the majority in Senate and Congress is very fragile. So we have to take a look at that. The government probably does need to raise some taxes. I do see a permanent 21% corporate tax rate going to 28%. I do see a rise in capital gains tax. I do see a diminishing in the estate tax exemptions and potentially an increase in the rate. But I don't necessarily, hopefully, don't see it at the extremes as if they have been proposed. So I'm not going to bore you with all of that. One last thing is, for those of us that have been doing estate planning for a long time, is we were able to, in the past, also create something which is known as a dynasty trust or a dynastic trust. And that was pretty cool. And that allowed us to set aside for Mark and Paul and for our children an amount of money that we put in a trust. We use up our tax credit, our 23 million, our 11.5 million. And by putting it in an appropriate jurisdiction, we would be able to have that money last in perpetuity, up to perpetuity, for children, grandchildren, great-grandchildren, great-grandchildren, called a dynasty trust, quote unquote, without it being subject to estate taxation. Now, in this proposal as well, no. We don't want to have that anymore either. So every 50 years across the land, from Maine to California, we will take every money that's in the trust, subject it to an estate tax and or gains tax. And so dynastic trust actually is a 50-year trust under the proposed legislation. And that, once again, gives the government consistent bites of the apple as we go along the way. So I think, when we look at all the things, I'm not going to get into some of the more specifics in this call. I think that doesn't serve our purpose, but one purpose, there is a winner. There's the winner in all this. The winner in this, should these proposals similar to this be adopted, which I think is more likely than not, most of them will be charities. Charitable deductions will be worth more. Forming private foundations for families and doing transfers through private foundations and doing good for the world. So we'll have a choice. I always turn around and made a circle. I always put on a board, and I divided the pie into 3 component parts. One component part was my children. Another component part was charity, because I've been fortunate enough to be successful. I want to help others less fortunate. And the third component of the pie was the government. And I close, and I'll take questions and answers from everybody with one simple comment. Pick 2. That's all you can. And if it's me, I pick my children and charity and not the government. And with that, I think you've got a pretty good picture of what we're here to talk about today. And the biggest takeaway is, let's see if we can get together, all of us, with us, somebody else. Don't put our head in the sand. Look at the due diligence, look at the options, things that we can do today, and let's move forward in getting that done. And with that, I'll open it up a little bit to Paul and Mark. I think we have some questions that are in the chat. So Paul, why don't you take a look on the chat and maybe I can answer some of them in just a few minutes, the 8-9 minutes that we have left.
Well, Harry, thank you very much. Covered quite a bit of turf there, from estates, gifting, capital gains, life insurance, and charities. We got a few questions here in chat. First is, how are you advising family-owned businesses who want to get the business to their kids, who want to get the business to kids who are working in the business? What type of advice you giving them right now?
Well, you know, you have all of the issues that I just come to play literally in here. So the advice that we do now is there are many types of trust that we could take a business, for example, and we could turn that business, whether it be an S corporation or an LLC, for example, or even a C corporation, and we can recapitalize that business into voting and non-voting interests, and then mom and dad can hold on to the voting interest for voting control, and then we can take the non-voting interests in that business and put it into a protective trust for the children today, up to that $23 million, successfully transition assets from one generation to the next. And so the only thing that's left that's moving on the business on the death of the parents is the control issue, but we've gotten the economics and all the growth on the business for the rest of the parents' life in the children's estate. We can still do that now, but that's going to turn into potentially $1 million, which will pretty much end that. So Mark, we have this runway now, and we don't know exactly what that runway is going to look like. It doesn't look very good moving forward.
Okay, thank you, Harry. Next question is related to step up in basis that you just covered. The question is, some commentators are asking for a longer runway of 4 to 5 years to implement that, since it's so dramatic. What's the likelihood of that happening?
Well, you know, I think that I would love to. First of all, I would like to see no change. They've, on all the attempts in the past, this is important for everyone who's listening to understand, to eliminate the step up in basis on death, they have all failed. So I hope that they fail again, but I'm a little worried about this particular time. And then the implementation of that, or the integration of that, you know, it depends on the goal. So you see, that would make more sane policy if we had 4 or 5 years of a runway to work on a disposition from generation 1 to generation 2. We can help most people. You know, we kind of hit that sweet spot between the people that are trying to confiscate assets and those of us that are trying to maintain for the family. But here's the issue on that. So, and there are commentators that say there are enough moderate Democrats that most of these proposals won't stand the chance of being implemented. And why would you implement them? We're just trying to come out of a national pandemic. It's kind of lunacy. But we have to remember the reason for this is a progressive lunacy. So I am not. Here's the way I look at this one, Mark. It's the way I look at the rest. There may be a longer runway for the implementation, but a very short runway for the tools that we have to deal with the implementation. So in essence, there's that 3 years or 4 years till as it kicks in gradually, but we can't do very much about it because you took all of our tools away. So I think that there's two edges to that sword.
Okay, thanks, Harry. This one's relative to California. I'm not sure the applicability to Arizona, but you could answer that. Since California has no gift or inheritance tax, and Prop 19 is moving in that direction with step-ups in Prop 13 property taxes, are there any other issues around the corner that they can expect in California?
Oh yeah, California is conjuring around in the legislature a wealth tax, first one in the country, which requires an amendment to the California Constitution. I don't think we're going to see that happen. They're also trying to increase our income tax from 13 to 16%. That might happen, or some compromise along the way. Proposition 19. Just for those that are listening, there is legislation now in Sacramento to delay the implementation of Proposition 19. It was a horrible piece of legislation that kind of buffaloed the voters in California for a couple of years to allow people a little planning to go to the next generation. But we don't know about the outcome of that. But there is no, they attempted last year, year before last, in 2019, to implement the Californian inheritance and gift tax. Why not? We have every other tax on the planet, and that actually died in committee. So I guess enough people are leaving California in droves that they give them second thoughts on doing some of these things. Okay, I think we have time for like one more question.
Yeah, looking for another one here, Harry.
Or if we don't have any other ones, we're done.
No, I think that about covers it.
Okay.
Harry, thank you so much for your time today and for your insight on a number of areas, important areas to everybody on the tax front. And if someone would want to reach out to you and learn more about your practice, how would they go about doing that?
Well, I'm going to leave that over to Paul, who's going to turn around and tell people how to contact us. So I'm going to leave all of you to chatting about that, and with Paul to tell you how to reach us for a complimentary consultation to discuss anything further that we talked about today. And Mark, thank you so much for having me. I enjoyed speaking to you, and I look forward to speaking to all of your people very shortly. Thank you so much.
Thanks, Harry. Yeah, so I'll just sign off real quick here. I know we got a minute. I'm Paul, I work with Harry, and I put it in the chat. If you want to get one-on-one with Harry, he can't address all the questions. I know there are a few more there we couldn't get to, but if you text guard assets to the number I shared in chat, if you write that down or take a picture of that, get one-on-one with the team. It's just completely complimentary. We'll get you some input on your own situation. We love giving back for anybody that's taking the time to join us on one of our webinars. So thank you. And Mark, thanks so much for having us. Fantastic.
All right, great to be with you, Paul, Harry. If you'd like to learn more about Vistage and CEO peer groups, feel free to reach out to me direct on LinkedIn or at mckern@gmail.com. I'd love to hear from you, tell you about the great group of leaders I have the privilege of working with and in our Phoenix Valley community. So again, thanks for joining us today. More information will come out on my next talk, which will be on June 17th. Look for it on LinkedIn events. Wishing everybody a good day and a great weekend into the weekend. Be well.